In this video, I would like to illustrate the price continuum, how price is coming to an inefficiency or seeking liquidity, right? So it's really simple and I'm quite excited to share it with you. So this is the Euro US dollar on the 12-month chart, which is the yearly chart. So every candle here is basically 1 year. Starting from here, and I want to show you how this price continuum is happening throughout all the time frames and how one could possibly implement it into their strategy and have a more confidence in their bias whilst trading. Okay, so here on the yearly chart, we see a BISI created, which is a buy side imbalance, sell side inefficiency. The opposite would be a sell side imbalance, buy side inefficiency. One is basically a bullish fair value gap and the other is a bearish fair value gap. Ignore this one to the right for a moment and let's have a look at this one on the left. Okay, so we see a fair value gap created and we see price trade into it and then we see price expand higher. Furthermore, there's a breaker in here as well, which adds a lot of confluence to your fair value gaps. Price creates an inefficiency. It seeks the inefficiency and then it seeks liquidity. So it's going from inefficiency to liquidity to inefficiency to liquidity, so on. It keeps on gyrating, doing these two things throughout all the time frames. So pretty simple here. How can we use this to our advantage, right? So basically, let's say you were looking at this yearly chart and you saw that price already came into this yearly gap. You know, by the time you're looking at price, maybe it's down here, maybe it's in the middle, maybe it's even higher up. It doesn't matter, right? You don't have to wait for the yearly chart to form and you don't have to wait for a yearly gap. You can just do your analysis on the chart and find out where you are and be more aligned with your bias. So let's go down to a lower time frame and see what's happening. But just to give you an example of how big this move is from, you know, the top of the gap to the top of this fair value gap, its high is, I would say it's almost 2,000 pips, which would be considered a lot if you manage to catch the bottom. But let's say you did not catch the bottom, you're looking for more confirmation. Nobody wants to catch a falling candle on the yearly chart. So let's go down to the 2 months. So this is price coming into the yearly fair value gap and it creates pretty much the exact same thing that you saw on the yearly chart. If we go back to the yearly chart again, you saw this tall breaker created, price expand above the breaker, retrace into it, and then expanded, seeking the high of the fair value gap that was created. Go to the 2 months. Let's zoom in again. You see almost the same thing. You see the breaker, price expanded, created a fair value gap, price traded into it, and then expanded, taking the high of the fair value gap. So it came to an inefficiency and then seek liquidity. But remember, we traded into the yearly gap and we're anticipating price reaching for the liquidity up here. You don't have to target that high because, like I said, price is moving through all the time frames. So trying to manage all the time frames can be a little bit tricky, especially if you're newer. So your best bet is on the time frame that you're doing your main analysis on is to target the liquidity above the high. If you manage to catch a good trade at the bottom and you want to leave a runner, you can always do that. That's part of your strategy and that's completely up to you and your style of trading, right? So yeah, price comes to the 2 months and then seeks liquidity. If we go down to a lower time frame, we can see the exact same thing. Let's go down to the 3-day time frame. All right. So within this weekly move, this is what happened on the daily, right? If we look at the yearly move, this is what happened on the yearly. All these daily 3-day candles got created and yada yada yada. We saw that 2-week gap got created, price traded into it, and came to get the liquidity. And we saw a 3-day gap got created down here, price traded into it, and took out the liquidity above the high, right? Just cutting through the candles here so you can see. Price came to the high. But what did price do? Let's say you were in a trade. You got in here. Let's say you got in there. Or let's say you just put a limit at the gap. And maybe you had your stop at the bottom and you think to yourself, okay, I want to take this to the high here. Like most traders would target highs. If you're using the yearly analysis, maybe you'd even target this high, right? You'd come all the way to there. But let's just say you wanted to target the weekly high or even this high. So you get in your trade, you see it moving. Great, it's moving. It's already 100 pips up. You thought if you hold your trade another 100 pips, you get that high, you make double your profit. To be safe, you move your stop loss to break even. Price comes up, comes all the way down, stops you out, and then continues there. So why did price come into this 3-day gap twice? Just to show you quickly, there's also a 3-day gap here that you could have used, and the liquidity would be up here. So into the gap, take out the liquidity. Fills the inefficiency, takes out the liquidity. But just to go back to this 3-day gap, let's check on a higher time frame. Okay. This is where the 3-day gap was. No, it was down here. This is where the 3-day gap was. This is price trading into the 3-day gap. And this is price coming back again into the 3-day gap. But here we see a 4-day gap, a 4-day BC. Price only trades into it once. And what does it do? It takes the high here, the liquidity. So let me just make this, let's just change the color so we can see. I'll just make it red. I'll make this one red and I'll make it visible on the 3-day as well. Just so you can compare the two. Okay, so now we're on the 3-day time frame, and we can see price trade into the 3-day gap once and again, but it only trades into the 4-day gap once. And this would be the high of the 3-day gap, which if you did take the 3-day gap, you could have taken that high. But this is the high of the 4-day BC over here. So when price trades into that, what does it do? Fills an inefficiency, seeks liquidity. And we are in a buy program on this time frame. The ultimate goal of seeking the high on the yearly gap over there. You can do this on any amount of time frames. So what you could do is, if you see price trade into this weekly gap over here, 2-week gap, you could wait for a daily or any number of days, a smaller time frame gap to form. You don't want to go too low because it won't be applicable. So you could have waited for this 3-day gap to form, taken a trade there. Whilst your trade was panning out, you could have noticed a 4-day gap formed, a relevant one, and you could have taken that trade as well. But if you weren't, if you weren't understanding these these concepts, looking at the chart, it might be a little bit confusing. You see a gap, price trades into it, expands, it comes back to the gap, and you're wondering what happened. Why did I get stopped out? Or why is price coming back into the same gap? Well, now you know, right? Price is shuffling through all the time frames, filling in inefficiencies and seeking liquidity. For more perspective again, let's go back to the yearly time frame. On the yearly time frame, it looks very clean, very simple. Gap created, breaker, great. Just target the high. If you want to go above and beyond, you can even target this high. It's almost 3,000 pips, 2,800 pips. And what do we see on the yearly chart? Price kind of consolidate in this area. Nothing on the yearly. If you don't see anything on the yearly, you can go down to lower time frames to to find trades there, and your targets would be based on those time frames. The highest probability target is the high of the candle fair value gap. The fair value gap is 3 candles. You can take it at the high. If it's a bearish gap, you can take it at the low. So one example here, a yearly gap finally got created. Price trades into it. Trades into it once, twice, 2, 3 times before expanding lower. I can't go to a higher time frame to analyze it more. This is the highest time frame I can go, but you can see how it works. Price comes into an inefficiency, sometimes a couple of times, bounces off an order block, comes again, gets rejected, and takes the liquidity here. Okay, so you may notice now there's another gap here. In this case, you should go to a lower time frame and frame a trade there, because this is too many candles that have passed. It's not applicable for this price continuum concept. You want a candle that trades into a gap, only a couple or few candles later. If too many candles have passed and you see structure being formed, you need to go to a higher time frame and see if there's a gap there, or is price seeking liquidity. I can't go higher than the 12-month time frame, but perhaps on a, who knows, on a 5-year or 10-year time frame, each candle is 10 years, you might be able to see other gaps that get traded too, and then price seeking the liquidity above the high or low of those 3 candles. So if you were taking a trade from here or somewhere in between, writing it down to this level as your target, which is also this low as well, equal lows got created, which is even more higher probability for you. Price is in this gap now, and well, it traded to the gap, had a reaction, and now we're here, right? So price is kind of in the middle of these two PD arrays. In that case, you could see some consolidation take place. If we go down to the 2-month again, you can do your analysis here. So you can see how price is bouncing off this these time frames. You see a gap get created here, but why I wouldn't consider this gap is because too many candles have passed. 1, 2, 3, 4. Price has already done something on a higher time frame. So if we go to maybe a 4-month, not visible, nothing on a 4-month, no inefficiencies on a 4-month, except this inefficiency here. So price trades to an inefficiency. It's possible that it comes down and takes the liquidity here. But because we're at such a discount in such a strong fair value gap, a yearly BC, in this case, you'd have to use your own discretion, not expecting it to take another low with too much confidence, because price could come down and then reverse and then go up to reach for higher prices or potentially even break new highs. This works on any market. There's a lot of day traders out there who are asking how they can implement this. So if we go down to, like I said, it works on any time frame. Unfortunately, I can't backtest all the way back there. It's too far away, and the candles won't go that far back on lower time frames. But for this example, let me delete this box here. If you're basing it off inefficiencies, remember seeing this one. Okay, this is a 3-day SIBI. We see a gap get created, and we see price trade into it. Let's go look at the daily. We see a larger gap on the daily, and we see price come into it once, 2 times. But the tricky part could have been this 3rd time into the gap. We'll see again on the 3-day. We see an inefficiency and price trade into that gap. But if you were going down to the 15-minute, you may be wondering, why did price just come above this high and then break down, consolidate, and then break down all the way? Now you know, based on the price continuum, and you can expect these things and have more confidence in your trades. Alright, I hope that was educational, and I hope you can use this to your benefit, because I believe that it's very useful in reading price. You don't have to look at entire charts and try and guess which fair value gap is going to be traded to. You start off on a higher time frame and looking only at a few candles, and then you work your way down. I believe that's the best type of top-down analysis, rather than looking at a higher time frame and thinking, is this fair value gap, is that gonna provide support, is that gonna hold, when you already know the bias of this yearly time frame. Price wants to come down and seek liquidity. You see price create this order block, this consolidation, the manipulation during COVID, comes all the way to there, comes up again to psych people out one more time, and then breaks down. Yeah, again, these are weekly candles. There's so many opportunities. With a little bit of patience and refinement of your strategy, you could be very profitable.